this video, I'm talking about liquidity sweeps and exactly what to look for.
So generally, if you want to dollar cost average down into a company, which basically means you want to buy at lows and then buy more and more and more as it keeps going down, you don't want to do this with companies that have a low chance of going to zero. The safest option would obviously be to use this in an index. With the example I showed before, if you just started buying at lows, you would have bought some when price crossed here, you'd have bought some when price crossed here, and you'd have bought some when price crossed here, and overall your average entry would be down here, and you'd be in a pretty good position. But if you did this with a company like Coinbase and you just kept buying, you'd have bought some here. Maybe you would have caught some rejection off that area. You'd have bought some here, and it would completely go down. And you'd have bought some here, and again, you're faced with some rejection off that area. But overall, you'd be down, which is why you have to be very careful in the stocks that you pick. Now, I have a list of stocks that I believe are powerful enough to be able to just dollar cost average into them. So if you'd like to see them, let me know in the comments down below, and I'll send them over to you. Since you're buying when everyone else is selling, you would buy at the bottom of moves. And so once the company reaches all-time highs again, you should just hold it, and then when it goes back down, you can buy more of it. That's how the rich get richer. They just buy more when the company goes down because they're way above their break-even price, so they know that in the future the company's just going to keep on rising. Now, onto a more advanced concept. How do you actually find these good lows? Let's use MasterCard as an example. So you see this company was going up, down, up, had a really big down move right here, and then it started consolidating, kind of started staying in the same area until finally it went down. Now, where here do you think is a strong monthly low? If you said right here, you'd be completely correct. A low of this size and caliber that just turned into a wick is sure to cause a reaction off the market. Now, this isn't to say that market is just going to flat out reverse off of this low once it hits it, but it does mean that it's a great place to dollar cost average into. And as you can see, price actually touched this point and already reacted over 5% off of it, which, if you know a company like MasterCard, that is a big deal. I might notice that on MasterCard, I'm using monthly lows, as indicated by the monthly tab, while on ES, I was using weekly lows. The reason I was able to buy when it was a weekly low on ES is because it is an index, so it is generally much safer, so I can assume that I can generally buy it even though it's just a weekly low and not a monthly low being swept. Additionally, if you look here, there were 0 monthly lows in this entire up move apart from this monthly low. But if you scaled into the weekly, you'd see that there's a lot more weekly lows that you could buy from. I'm not saying you should buy off of each one of these lows, because I would like you to actually pair them with different levels that you'll learn in future videos, like this little consolidation block, this order block, and previous all-time highs, which if you would have bought beneath these lows, in this block, and at these all-time highs, you'd have had no problem catching this reversal. Now here's another example, Domino's. Where do you think you should start buying Domino's? If you said right at this low, you are right.
How did you know the answer?
If you can see, this is the monthly time frame. Domino's is clearly a strong company, and it is held through the test of time, it being a tradable stock all the way to July 2004. Domino's had these lows right here that were all pushed past with the next consecutive low. Then it had a rejection and started going upwards, and now it is suddenly falling back to those same lows again. Nothing is completely confirmed. Domino's could hit those lows and keep going down, but to make the most amount of money and to lose the least amount of money, we can make sure to buy at the best possible spot. Now, you guys are not familiar with this concept yet, but if you take the equilibrium point from the all-time lows of Domino's up to the all-time highs, you can see that these monthly lows are incredibly close to the equilibrium point, meaning that if Domino's decided to push into these monthly lows, it would be hitting another level that could cause it to go back to the upside. On top of this, you may see that these lows perfectly align with these previous all-time highs. To show you another example of this equilibrium point working, we can head over to Netflix. From those lows to those highs, we can see that as soon as Netflix barely touched this equilibrium point, it completely retraced off this, and you would have caught a nasty 45% move. Now you might be thinking, what about the liquidity? We just learned about liquidity. Well, if you could see, there's actually a monthly low right here. And so if you would have seen that monthly low, and you decided to pair it with this equilibrium point, you'd have seen that market has enough orders to go up, but it might not have enough levels. And then once it hit that equilibrium point, you would have bought and been in a pretty happy position. Now this is previous all-time highs. As we can see, market never reached down to this price, which could give us another buying opportunity. Here's another example, Dell. Now using what you've learned about lows, where do you think you would buy Dell? If you said this low, you are correct, but you can also see that there's this low. And so if you said that low, you are also correct. Once the price hit the monthly low, which was right here, you would have bought. Now trading is a long-term game, so for 65 days, you'd be sitting in the trade around at your break-even price. But if you were patient and calm while others were panicking, while the price was consolidating and going down, you would have been part of this crazy 292 0.98% gain. Now, if you want to learn how to use equilibrium to correctly predict market reversals, leave a comment. But let's go back to solely focusing on lows. Here's a chart of IBM. IBM had a monthly low right here, but it also had a monthly low right here and right here. Now, if you're thinking, well, then when do I start buying the stock? Well, if you're really confident and you really want to hold it for the long term, you could start buying it at each one of these monthly lows. But if you want to be a little more safer and you want to catch the absolute reversal point of the stock, you can look at it this way. What's better than one low? Two lows. Price dipped to this point 2 separate times, and it dipped to nearly the exact same point. So regular people that are going to panic, they're going to put their stop losses below those lows, while banks and the rich, they look at this as, wow, many retail traders, the dumb money, are placing all their stop losses below these lows. Why don't we push price down to those lows, get all our orders filled, and then send price shooting upward? What happens? You can see exactly that. Price dumps down because of a poor earnings report by IBM, then consolidates a little, and then just keeps falling down until it hits these lows. Zooming in on a daily, you can see that the day it taps into these lows, it starts reversing, and every single day after that, it went up all the way to the all-time highs. For IBM to make it from those all-time highs to those monthly lows, it took 124 days. For IBM to make it from those lows back to all-time highs, it took just 12 days. Now, if you can't see that there's clearly some market manipulation at play, you need to open your eyes wider. Now, if you master this one skill of finding out good and solid lows to buy off of, you're already better off than most investors. If you manage to buy at these low points, and then sell at the high points, which in this case was a 51% gain to all-time highs, you are already sitting in profit when most people have lost money in the market. Even if you don't sell, which is the ideal scenario, you will have bought at the lowest point that the market went. Meaning that in the future, even when price reverses, as it's doing right now, you would be sitting in a profit, and it would be much easier for you to stomach the price than someone who bought at the top and is now seeing the company fall. So now that was a quick overview of liquidity and how you can actually see it in the market and how you can use it to find entry points. Comment down below if you'd like to see a similar video on equilibrium and previous all-time highs, and then I'll post another video on combining all of the levels together for you to actually master the art of investing. People always say it is impossible to buy at bottoms, and that's partially true. It is impossible to buy at bottoms 100% of the time, but it is not possible to buy at bottoms at least that 1% of the time. If we see this Netflix example, with all the examples I showed you, you were mostly able to buy at the bottom of the trade. Don't let anyone tell you that trading is a scam or it's gambling, because if you are able to invest correctly, you are actually able to put your money where your mouth is while they keep talking. Now, one last example, and this might be a doozy, is crypto. Now, crypto, in my opinion, is a lot less safe than a specific stock or an index, because obviously it has very little narrative around it. Bitcoin, for example, reached its all-time highs all the way back in October, and from that point, it's fallen 50%. But if you look at this, you can see that from its low, it encountered a high point of 37%, which is an incredibly solid gain if you were able to capitalize on that. Now, because crypto is much more riskier than investing in an index, you shouldn't buy purely off of monthly lows. You should definitely combine it with different levels. In this case, you see that there's a monthly low right here, and that monthly low aligns almost perfectly with previous all-time highs right here, which you can see I drew the zone with the box. Now, because crypto is a lot riskier, my first entry point was at the body of the all-time highs below the monthly lows as indicated by this red line. Then I used the middle of this order block zone as a second buying opportunity because it aligned with its own previous all-time highs. And what ended up happening is that my average buy-in was around this price. Now, putting aside the fact that many people bought at 100,000, 80,000, 70,000, you would have bought at a reversal point while everyone else was buying while it was going down. As you can see, even though price is going down, it clearly had a reversal point off of this low. And that just goes to show that sometimes market can still go against you, but as long as your reasoning for the investment was correct, you can reap some of the benefits. In this case, if you bought at those lows, your average entry would be here. And in this investment, at one point, you would be up 25%. Now, I will discuss profit zones later. This strategy is applicable everywhere. It's applicable in indexes, in stocks, and in cryptocurrency. Wherever there's money, banks are going to try to manipulate it in a way to get more of it. So if you want to learn how to trade on the side of the banks, watch these videos, apply this to your own investing. Don't just watch them and then go play video games all day. Apply this, actually buy a stock, and then watch as over time your portfolio is going to grow. Thank you for watching, and I'll see you in the next one. Peace.